Hey, I'm Christina, a mortgage loan officer that helps first-time homebuyers and self-employed borrowers make their mortgage a win. The housing market is brutal right now, and if it feels like the odds are stacked against you, they kind of are. But after helping buyers get into their first home after other lenders said no, I've learned that the market isn't your biggest problem. There's one rule most first-time home buyers do not know exists. And in this video, I'm breaking down what exactly that rule is and how my clients are getting around it. Let me paint you a picture. You graduate college, you landed a solid job, you've been saving, you're responsible, you spend your Saturday morning walking around open houses. There's a nice neighborhood, 3 bedrooms, the kind of place you actually see yourself living in. You think one day maybe it's time, so you call a lender. Then they tell you something that stops you cold. Sorry, you do not qualify. And then you're sitting here thinking, what do you mean I don't qualify? I have a job, I have savings, I've been doing everything right. Or maybe that isn't your story. Maybe you just graduated, you landed a brand new high-paying job, you have a big promotion, a career change that you've been working really hard for, and on paper you're making more money than ever in your lifetime. You finally feel confident, you finally feel like you have enough income to make this happen. Different story, same gut punch. Because more income should mean more options, right? But it doesn't always work that way. Here's what nobody tells you. Most of the time, it's not the income that disqualifies you or even the lender. It's you, without even knowing it. The decisions you made before you picked up the phone, the job you just switched, the loan you co-signed for a friend, the car payment you took 6 months ago. These are things that quietly close the door before you even get a real shot at opening it. Most loan programs require a 2-year work history in the same field before they'll count your income. So if you graduated, just changed careers, just promoted into a brand new role, you may have disqualified yourself without even realizing it. Not because you did something wrong, but because nobody told you the rule existed before you made the move. But here's what most lenders don't bother to tell you. That 2-year history doesn't have to be 2 years at your current employer. If you were in school before you started working, that counts. Your education counts towards your 2-year work history. If you were working part-time job in the same field while you're in school, that counts. If you served in the military, that counts. The timeline is longer than you think, and you may have already have qualifying history than you realize. And what if you started a new job? We can often use your current pay to qualify you. But there's a catch that most people don't know about. There's a different calculation for someone that's receiving guaranteed 40 hours versus someone that's getting variable part-time that changes week to week. That's different calculations for the income. And it matters a lot more on how you're going to get paid, whether you're W-2, 1099, or you're self-employed. Self-employed income works completely different, and it needs its own strategy entirely. You don't need 2-year history at the same company if you know which bucket it actually falls into and how to document it. You need the right loan officer who knows how to put the full picture together and not just piece the easiest ones to see. There's a second version of this mistake that people don't see coming. Some people think that the number that the lender approves them for is the number that they need to spend. It's not the same thing. A lender's job is to give you what your ceiling is, what your max approval is, and make sure it fits within the guidelines. Not what actually fits into your life. Nobody at the bank is asking about your retirement, your emergency funds, or what your life truly will be with that mortgage payment. And so that's different. I like to sit down and talk about those as a whole because buying a home is going to be your biggest purchase of your life. And I want to make sure that it also fits into your long-term goals. That's the problem with most buyers. They hear the word no, they see one number, and they assume that's the whole story. But the rules and your options have more flexibility than anyone tells you about. And if you disqualify yourself without knowing it, the power was always in your hands. With the right information, you can get it back. But before I show you, you need to understand why the market feels so impossible right now. Because it's not just the one rule that's working against you. So let's talk about what's actually happening here. Because I talk to first-time homebuyers every single day. I hear the same thing over and over again. I don't know who to trust. This process seems so complicated. Everything I looked at goes pending. It's under contract before I even have a chance. Like, I'm scared to get rejected. And I get it, I genuinely do. Because the mortgage industry has done a terrible job of explaining itself. You go online, you do more research, and you end up more confused than when you even started. Your parents are telling you one thing, your friends are telling you something else, and then some random person on Reddit thread is telling you something different. And meanwhile, the market keeps moving. Prices keep climbing. And every month you wait, the dream seems like it's further and further away. Here's the truth that nobody is saying out loud. The biggest thing standing between you and your first home is not the market. It's not your credit. It's not even your down payment. It's the lack of information. The buyers winning right now that are walking through open house on Saturdays and getting into contract on Monday are the ones that found someone who showed them the rules that actually matter. And more importantly, debunks those myths that are out there. Guidelines change constantly. What was true 6 months ago may not be true today. A program that didn't exist last year might be the one you qualify for now. And every market is different. What works for a buyer in California looks completely different than what works in Tennessee or Texas. There's no one-size-fits-all answer, and that's why going on Google for mortgage advice is one of the most dangerous things that you can do. And that's why I want you to use me as a resource. Not just when you're ready to buy, not just right now, whether you think you're gonna qualify or not. A 5-minute conversation with me can tell you a lot more where you stand in the process than doing 5 hours of research on your own. And it costs you nothing. Okay, let's start with 3 silent killers. These are the things that nobody warns you about until it's too late, until you're on the phone with a lender and wondering why the numbers don't work. Silent killer number 1, your car payment. I know, you need a car. It made sense at the time. But here's what a large payment on your mortgage application can mean. Lenders look at what's called a debt-to-income ratio, or DTI. It's the percentage of your monthly income that goes to debt payments. A $600 or $7 car payment eats into that ratio real fast. And it could be the difference between qualifying for a home that you want or settling for something that's significantly smaller, or not qualifying at all. Before you buy your next car or upgrade the one you have, please talk to your lender. That car payment might cost you more than that sticker price. Silent killer number 2, co-signing for someone else. Your friend needs a loan, your sibling's trying to get a new car, they ask you to co-sign, and you want to help, you do. And now that debt shows up on your credit report as if it's yours, because legally it is. And if they miss a payment, it hits your credit. And even if they don't miss a payment, that goes towards your monthly obligations, counting against your debt to income ratio, just as if you took the loan out yourself. Co-signing can quietly disqualify you from your own mortgage without you even knowing that was the problem. Silent killer number 3, not knowing about down payment assistance programs. This isn't something that you're doing wrong per se, but it's something you didn't know exists. And it might be the most important thing in this entire video. There's a quieter mistake that happens even after you avoid all those 3 things. People get pre-approved and they feel like they crossed the finish line. They go finance a new car, they open up a credit card, they co-sign for somebody, they deposited large sums of cash into their account. Any one of these can undo the entire pre-approval process right before closing. The house didn't fall through because they couldn't afford it. It fell through because they didn't know the pre-approval is conditional, not permanent until the keys are in your hands. If you're watching this and thinking, okay, this might apply to me, don't wait. Don't spend another 6 months trying to figure it out on your own. The sooner you have a real conversation with someone who specializes in creative financing, the sooner you know exactly where you stand. Keep watching, because what's coming next might completely change what you think is possible. Let's talk about down payment assistance programs. Because the number 1 myth I hear from first-time homebuyers is I need 20% down. I hear it constantly. It's simply not true. And more than that, there's programs specifically designed to hand you that down payment. And most buyers never heard a single one of them. Down payment assistance programs exist at the state level, the county level, the city level, or the national level. Depending on where you're buying, you might qualify for multiple programs. If you're in California, one of the biggest is CalHFA, California Housing Finance Agency. CalHFA offers multiple loan programs specifically for first-time homebuyers, including down payment assistance that cover a significant portion of what you need to get into a home. It's backed by the state, available to buyers who meet the income and purchase price limits for their county. Okay, and before you disqualify yourself, the income limits are very generous. For example, in Santa Clara County, the maximum income you can make is $325,000. Now, if you're purchasing in San Joaquin County, the maximum income limit is $214,000. Some of these programs will even give you 5% of your down payment and closing costs. And here's the part that people don't know. If you install solar, that assistance can be completely forgiven. Not deferred, not repaid when you sell, completely forgiven. You end up with 100% ownership and the money to get you into the door. And those are just 2 programs. There's other city programs, county programs, employer-assisted programs, programs for teachers, programs for nurses, programs for first responders. And the point is, before you assume that you don't have the funds for the down payment, find out what program exists in your area. There's money sitting on the table specifically for first-time homebuyers. And most people never claim it because they never asked, or because the lender is not on the approved lender list like I am. But down payment assistance is just one piece. Even if you have the down payment handled, there's still a question on whether or not you qualify for the loan. And for self-employed borrowers, contractors, gig workers, that's where things get complicated. And this next story is going to change on what you think is possible. I want to tell you a story about a client of mine. He was an Uber driver, and on his tax returns, it showed that he had $60,000 in income. Every lender he talked to looked at that number and told him the same thing. You don't qualify for much. Maybe a small condo, maybe nothing in this market. What those lenders didn't bother to look at is his 1099s. It told a completely different story. His tax return showed $60,000 because he wrote off everything. Mileage, depreciation, phones, insurance, all completely legal, smart even, but his income looked tiny on paper. His 1099s, the raw income before write-off showed $175,000 in actual earnings. So we used that instead. With this qualifying 1099 income, I was able to get him approved for a $750,000 home, 15% down, no mortgage insurance. Most people don't even know that mortgage insurance isn't always required, even under 20% down. There are specific programs that eliminate that completely. On a home like that, that's hundreds of dollars a month that he's saving for this program. An Uber driver, $60,000 on taxes, $750,000 home, no mortgage insurance. That's what knowing the right strategy does for you. And there's one more myth I constantly hear that keeps good buyers on the sidelines for long. I'll just wait till rates come down. I get it, rates are higher than a few years ago, and it feels like a smart move to hold off. But here's what nobody's telling you. And when rates drops, and they will, every buyer who's been sitting on the sideline floods to the market at the same time, and prices go up. Competition goes through the roof. And the house that you could have made an offer on today, and now you're on a bidding war with 15 other people. The buyers who wins are the ones that buys when it's quiet and then refinances when rates drop. The rate you get today isn't the rate you're stuck with forever. When rates come down, you refinance and swap your current loan for a new one at a lower rate. Your payment goes down. It's not complicated. It's just a process. So what you're doing right now is locking in that home at today's price before the competition goes back, and then adjusting the rate later when the market gives you the opportunity to do so. I had a client that almost walked away because the payment felt too high at today's rate. We walked through what exactly refinancing works, so she can see to the future payment. And she moved forward. She found a home, she placed the offer, and she won. No bidding war, no waiving inspections, just to stay in the running. She picked her home on her own terms because she moved while everyone else was waiting for the rates that haven't arrived yet. And if you've served in the military, what I'm about to tell you might be the most powerful home buying tool that exists in this entire country. If you're a veteran or active duty, you have access to the VA loan. 100% financing, 0 down payment, and no mortgage insurance. Not reduced, none. On a $500,000 home, mortgage insurance without that benefit can add $200 to $300, $400 a month. And that money doesn't go towards your balance, your equity, or your principal. With a VA loan, it does not exist. But here's something people don't talk about when it comes to actually winning in this market: speed. In the market like the Bay Area, you can have an open house first weekend, offers due Monday, maybe Tuesday, get into contract Wednesday, and expect a 15 to 18 day close. It's fast. And in other markets, it can be 21 to 25 days. Regardless of where you're buying, being fully underwritten is critical before you step into an open house. Because when you find the home that you want, you don't have time to start the process. It needs to already be done. If you've served this country and haven't used your VA benefit or didn't know you had it, a conversation needs to be had. This is the conversation to have immediately. It's earned, it's yours. And a lot of veterans are shocked that buying a home is within reach right now. Okay, so let's bring this all together. I want you to have a clear picture of what you need because I want you to leave with a clear picture of what's actually possible and what your next move should be. The rule we started with, the 2-year employment history is required. 1099 income qualification exists for self-employed buyers whose write-off makes their tax returns look worse than reality. VA loans exist for veterans, 100% financing, no mortgage insurance, earned and waiting to be used. Down payment assistance programs like CalHFA exist for buyers who think they can't afford their down payment. And fully underwritten exists for people who want to compete like cash buyers, so your offer can be as strong as possibly be. These tools are real. They're being used right now by buyers who are in the exact same spot as you are, walking through open houses every weekend, falling in love with homes, and walking back out convinced they couldn't qualify. And the difference between those buyers and the ones still going to open houses, just to look, is it money, is it credit, or timing? It's information. And now you have it. But the information alone isn't enough. You have to protect it. Go back to those 3 silent killers, watch your car payment, talk to a lender before you walk into the dealership, not after. Don't co-sign for anybody, no matter how much it feels like you're helping, that debt sits on your credit report like it's your own. And find out what down payment assistance programs are available to you. And once you've done it, don't undo it. Once you're pre-approved, don't finance anything new. Don't change jobs without telling your lender. Don't move large chunks of cash without telling your lender. And that's when it's time to shop. I can pair you with the right realtor, not just anyone, one that understands your numbers and how you can win in this market. Here's the last thing I want to say, and it's the most important part. The mortgage process has a reputation of being complicated and full of surprises. And with the wrong lender, it is. Costs change, communication disappears, and you're left navigating a maze blindfolded while your family gives advice from the sidelines with money that isn't theirs. But it doesn't have to be that way. The right lender starts with a soft pull, has no impact to your score, they communicate clearly at every step, and they fully underwrite your offer so it's as strong as it can be. I'm licensed in California, so if you're buying here, this is exactly what I do every day. Reach out and let's run your numbers. Now you know the biggest reasons why people get stuck. There's one more thing you need to watch out for. A mistake that costs people thousands and don't even realize that they're making it. So check out this video where I walk you through the top first homebuyer mistakes to avoid. So now you can go from never to going to confidence and no surprises.